Welcome to our Bloomberg radio and television audiences. I'm Michael Mckee, Bloomberg's international economics and policy correspondent. Joining me now, Dallas Fed President Robert Kaplan. Thanks for being with us today.
Good to see you, Mike.
We know basically that you and others on the Fed see about 2% growth for 2020 and about 2% inflation. So the forecast doesn't change all that much, but I'm wondering, how fragile do you think the economic expansion is right now? Would something that happens with Iran or China or something really knock us off track because we're so late into it?
Well, if anything, my estimates for 2020 have firmed a bit. And setting aside some unpredictable event, I still think global growth is going to be sluggish but stabilize. Manufacturing is going to be sluggish but stabilize, and business fixed investment is going to be dragged down by energy spending, for example, and it'll be sluggish, but it's going to stabilize. And then you combine those three things with a strong consumer, I think we're going to have a solid year next year, and my confidence in that might actually be improving a little bit.
So consumers, you feel, are fairly strongly confident at this point, and the scare of last summer is in the rearview mirror?
Or put it a different way, there may be months where the consumer pulls back, saves more, doesn't spend, but the capacity of the consumer to spend is solid. Household balance sheets are in much better shape than they've been in 10 years. Not perfect, but better shape. And we know the job market is very tight. So the consumer's got the ability to spend, and so over time, I think they will.
The president is signing the Phase 1 trade agreement with China today.
Yeah.
What are CEOs in your district telling you about the impact that will have?
So it's positive. It creates some stability. It doesn't remove trade issues going forward. We're going to have trade issues with China for years. But a Phase 1 deal is much better than the alternative, which would have been continued the September tariffs in place and escalating tariffs. And so this is much better than the alternative. So it's not that the deal itself for businesses I talk to is so significant, but the stability is significant. And then you combine that with hopefully USMCA getting ratified and some stability in the trade relationship with Mexico and Canada. And it doesn't remove trade issues and trade uncertainty, but it creates a little bit more predictability and a little more stability, and that's positive.
Should we see more business spending then?
Not necessarily. I think on balance, anything that helps reduce uncertainty will help business spending. And so I think it'll get a little better this year, a little bit more stable. You offset that against the fact that a big part of business spending in the United States, I mentioned earlier, is energy. And because global growth is sluggish, we think energy capex in 2020 could be down as much as 10 to 15%. And so you'll still see sluggish business spending, but on balance, all things being equal,
infrastructure spending, do we also see job losses at the same time?
We're seeing some job losses, actually, and we have seen some job losses. So you're right. The industry is more productive, can do more per well and per rig with fewer workers. But all things being equal, job growth in the energy sector is going to be very sluggish.
Now, you've cut rates three times last year, last time in October, which investors saw as a sort of a green light for investment. And after your December 5th meeting, when you basically forecast no rate moves this year at all, the S&P's been up 5% since then. Do you worry about your impact on asset prices?
Yes, I do. I do. And I think there's three aspects. There's one, rates are lower. And we lowered rates last year, and I was a supporter of those rate reductions because I was worried about weakness in the economy. Then there's a perception that the bar is higher for future rate increases. I don't know if I completely agree with that, but that's part of our communication. And then the third issue is, in order to address this repo issue, we've grown the balance sheet. And now I think we've done what we had to do, but I'm very sensitive from here that we need to be finding ways to limit and temper the growth in the Fed balance sheet. But I'm conscious all three of those all three of those actions are contributing to elevated risk asset valuations, and I think we ought to be sensitive to that at the FOMC, and I certainly am.
Well, you say it's not QE. A lot of our guests on this program from the market say it is QE. Yeah. So is it not QE if they believe it is?
So it's, on the one hand, it's not QE because we're not buying along the curve. On the other hand, my own view is it's having some effect on risk assets. It's a derivative of QE, and that when we buy bills and we inject more liquidity, it affects all risk assets, and I'm of that view. So for me, this is why I say growth in the balance sheet is not free. There's a cost to it, and we ought to be very disciplined about it and sensitive to it. I think we've done what we've needed to do up to now, but I think it's very important that we come up with a plan and communicate a plan for winding this down and tempering balance sheet growth, and I'm very hopeful that we will do that.
We are speaking with Dallas Fed President Robert Kaplan on Bloomberg Television and Radio worldwide. How surprised are you that unemployment has gotten this low without triggering inflation? Is there a change in inflation dynamics?
So I'm not that surprised, and you know, for the last few years I've been talking about the cyclical elements of inflation and the structural elements. So unemployment being low historically would have triggered more cost increases, wage increases, would have led to price increases. That's not happening now because the structural issues, which are technology and technology-enabled disruption, and the power of distributed computing power has really changed the ability of businesses to raise prices. And I think that's intensifying, and I expect it to intensify. So I actually think a good part of this muted inflation picture, which I expect to continue, is structural and is not going away. And I don't know that it's that susceptible to monetary policy, by the way. And so I take a little bit different view about how we ought to think about this. I would like us to take actions that help get to our 2% target, but not at the expense of financial stability and creating undue excesses and imbalances.
Well, that brings me to the policy framework review. You're a year into it. Where do you think it ends up? What are we going to see?
For me, the most important things, I think it's important that we highlight explicitly in the framework review that we'll consider explicitly financial stability, not just full employment and price stability, but also financial stability. I think you may see some changes to the way we articulate the inflation target. Either a range is something I'd be open to debating, or a longer averaging period. But those are analytics, and they're not a substitute for our judgment. And so I wouldn't want to see us be making analytical changes that commit us to future actions. So I think the most important thing from the framework review is a reiteration for me that we take a balanced approach to monetary policy that's forward-looking.
Kind of raises the question, I guess, the other big question for the markets is, with rates so low, what do you do when we enter the next recession? There's a big debate out at the American Economic Association about whether you have the tools.
We have less firepower than we've had historically. It goes without saying, with the Fed funds rate at 1.5 and 1 3/4. We certainly have the balance sheet tools, but for me, I've been emphasizing this situation, and what we see going around with central banks around the world suggests that we need broader economic policy in the United States and globally. We need fiscal policy, we need structural reforms, policies to grow the workforce, improve productivity, invest in infrastructure, and it can't all be the central bank. And so, yes, we have less firepower here. And for me, it's not that we ought to come up with new and more exotic tools at the Fed. It suggests this is a sign that we need to broaden economic policy in the United States to policies beyond just monetary policy.
Well, you guys are all saying we need additional fiscal policy, but there's no fiscal authority saying, yes, we should do that. When you talk to members of Congress, what do they say?
When I talk to members of Congress about slowing workforce growth and the need to invest in education, on both sides of the aisle, it's hard to not find enthusiastic agreement. There's just, the question is, can we get some of these policies done? What I'm finding is there is action being taken locally, for example, on education. So Texas is a good example where the state just passed substantial education reform, and there's substantial initiatives to do skills training. So there are actions happening. We just need to ramp them up. And when I'm talking about policies other than monetary policy, I'm not talking so much about a fiscal boost as I am about structural reforms. Immigration reform, and we've done a lot of work at the Dallas Fed that suggests we would be well served to look at Canada to have a more skills-based, employment-based immigration system. But if we don't have immigration, we think workforce growth is going to continue to decline. So those are the kinds of issues we need to be flagging, and monetary policy is not a substitute for action on those fronts.
Well, you're sort of describing what Larry Summers has called secular stagnation, low rates, low growth, low inflation. Alvin Hansen talked about it in the 1930s. Is that where we are today?
I don't know if I won't give a label to it, but I think there's no getting around the fact that the structural drivers in the U.S. economy and globally are leading to slower growth. And what I mean by that is, if you go back to the 70s, if workforce growth, let's say, was around plus or minus 2%, it's declining down to the point where in the 2010s, we think it'll be less than 1/4%. We've got to deal with that reality. I don't think we're talking about that enough. And we need policies, and we can do things that address that. But the reason I keep flagging it, and I'm glad others are flagging it, is there are things we need to do beyond just monetary policy.
Well, one last question about monetary policy. You may have heard it's an election year.
Yes, I've heard that.
The Fed historically stays on the path that they're on during an election year. If they're raising, they raise. If they were lowering, they lower. You're on hold. Mm-hmm. As you get closer to November, does that put more pressure on you just to stay on hold?
I know it's been a factor in the past. I think, though, everything I try to do in this job, and I think my colleagues around the table take the same approach, or try to divorce ourselves from political considerations or political influence. And if I felt strongly as we got into the middle of the year or later that we needed to take action, I would still want to be advocating action. At the moment, I'm not forecasting that, but I think we've got to do what's right for the U.S. economy.
All right. Robert Kaplan, president of the Dallas Federal Reserve Bank, thank you very much for joining us today.
Thanks, Mike.
We'll send it back to you.